Well, greetings. Today we're going to be looking at how we can evaluate taxes. The key idea here is that taxes are evaluated along two lines, whether they are fair and whether the same amount of money could be raised with less harm to the economy. So our objective today is explain the concept of efficiency as it relates to taxes, define two measures of tax fairness, one being vertical equity, the other being horizontal equity, and finally evaluate proposals for tax reform. So, as we know, a government can sometimes improve market outcomes by providing public goods, by regulating the use of common resources, and to counter the effects of externalities. To perform these functions, they need to raise taxes and they need to raise revenue, and they do it through raising taxes. So the key idea here, as I said before, our taxes are evaluated along two lines, whether they are fair and whether the same amount of money could be raised with less harm to the economy. So what do we already know? We already know that a tax on good reduces the market quantity of that good. Remember when we were speaking about cigarettes, we talked about the excise tax and what that does, and that the burden of a tax is shared between the buyers and the sellers, depending on the price elasticities of demand and supply. When we seek equity and efficiency in tax, the primary purpose of taxes is to raise enough money to pay for the government's activities and programs. The success of the tax system can be judged on two additional criteria, equity and efficiency. Efficiency, an efficient economy produces the greatest possible net gains for society. Taxes are a part of an efficient economic system because they allow the government to provide public goods such as national defense, education, police, and fire protection. And they always do this when the benefits exceed the cost. However, the collection of taxes imposes costs beyond the actual amount paid to the government. The added costs of sales and excise taxes come in the form of lost gains from trades between buyers and sellers that would otherwise take place, but are discouraged by taxation. The goal is to set up a tax system that collects a amount of revenue at the lowest possible cost to society. If the lost gains from trade are larger than necessary, the tax system is not efficient. Just like we talked about the excise tax, when you think about cigarettes, that reduces the quantity of goods below the efficient level. Income taxes reduce the quantity of labor below the efficient level. So how to improve tax efficiency? Taxes are generally more efficient if they cause people to change their behavior relatively little, and that's not including correcting for negative externalities such as pollution. Um, but one way to do this is to have all similar goods being taxed at the same rate. This will prevent people from substituting one good for another just because of the differential tax treatment. Suppose, for example, the hamburgers were taxed at the grocery store but not at fast food restaurants. This tax policy would be inefficient because some people would be swayed to drive to a fast food restaurant to buy a burger instead of grilling one at home. It is wasteful to drive to a restaurant if one would rather eat at home. So the changes in behavior caused by the tax reduce efficiency. A second way to improve tax efficiency is to create a lower marginal tax rate. And remember, we said marginal equals additional. It's rational for people to make decisions on the basis of marginal benefit versus marginal cost. So if the marginal tax rate on income, for example, is relatively high, the marginal benefit of working another hour will be low, so people won't do it. So the more people will choose to work less than if a lower marginal tax rate is applied. The third way we could improve the tax efficiency is the simple can be better or the less is more principle. A tax system that makes it easy to calculate and pay taxes reduces unproductive taxpayer effort. The U.S. tax system, is so complex that nearly $150 billion is spent by families, businesses, and governments each year to make sure that the right amount of taxes is paid and collected. A federal tax panel noted that it's more than the amount spent each year on TVs, household electricities, and breakfast cereal. Another goal of tax policy equity is distributing the burdens of taxes fairly. We have to do this by agreeing on what is fair. And agreeing on what is fair is so much harder than agreeing on what is efficient. Yet there are several principles that people apply to evaluate the equity of a tax system. The benefits principle. This is the idea that people should pay taxes based on the benefits they receive from government services. So this idea tries to make public goods similar to private goods. The more you use, the more you pay. A good example of this is gasoline tax. The more you drive on public roads, the more gas you buy, so the more gas tax you pay. Another idea is the ability to pay principle. The ability to pay principle is the idea that taxes should be levied on a person according to how well that person can shoulder the burden or how well that person can pay for it. This suggests that all taxpayers should make an equal sacrifice to support government. It also recognizes that the magnitude of the sacrifice depends not just on the tax payment, but on the person's income and other circumstances. So a $10,000 tax bill is a bigger sacrifice for a poor person than a rich person. So now let's talk about tax equity or fairness. Economists use two standards to evaluate fairness: vertical equity and horizontal equity. Vertical equity, it means that those who have a greater ability to pay taxes make a larger tax payment. Horizontal equity means that those with the same ability to pay taxes make the same tax payment. Let's explore how these standards of fairness are measured and achieved. Income serves as an available measure of people's ability to pay taxes. So we can measure vertical equity by looking at what happens to the amount of taxes that people pay as their income increases. One of these taxes is called a progressive tax. Now, a tax is progressive if people with a higher income pay a higher share of their income in taxes. An example of progressive tax in the U.S. is the federal income tax. Those with higher incomes generally pay a higher share of their income in taxes. Another type of tax that we have is called a regressive tax. A tax is regressive if the people with a higher income pay a lower share of their income in taxes. An example of a regressive tax is a sales tax on groceries. Now, suppose SpongeBob earns $1 million per year, 100 times as much income as Patrick, who earns only $10,000 per year. If they each bought the same amount of groceries each year and paid $1,000 in sales taxes, that would represent 1/10 of 1% of SpongeBob's income, but 10% of Patrick's income. People with high incomes tend to spend relatively more on groceries, but their expenditures typically do not increase the proportion to their income. That is, it's unlikely that SpongeBob would buy 100 quarts of milk for every one that Patrick buys. So the sales on groceries is regressive. A tax is proportional or flat if everyone pays the same share of their income in taxes, say 10%, regardless of their level of income. No U.S. tax is proportional, although a few come fairly close. One example is property tax. Expenditures on property increase more or less in proportion to income. So that is kind of one example that we can point to. So the summary here is progressive taxes provide the highest degree of vertical equity. Because not only do people with higher incomes pay more in taxes, they pay a higher share of their income in taxes. Proportional taxes achieve vertical equity because they require higher payments from people with higher incomes. But everybody pays the same share of their income. Regressive taxes may or may not provide vertical equity. For example, in the case of the sales tax on grocery, people with higher incomes devote a relatively low percentage of their income to groceries, but they still spend relatively more on groceries and thus pay more for the tax. A tax on something that lowers income people spend more money on than higher income people, such as used cars, would be so regressive that it would not achieve vertical equity. Instead, the people with the lowest ability to pay would end up paying the largest amount in taxes because they spend more on used cars. All right, now let's talk about horizontal equity. Horizontal equity requires that people who have the same level of income pay the same amount in taxes. The basis for this idea is straightforward. You probably would not think it was fair if someone who made just as much money as you paid less in taxes than you did. The U.S. tax system is sufficiently complicated that people with the same income often do not pay the same taxes. Matter of fact, they usually pay different amount in taxes. Most importantly, some different sources of income are taxed at different rates. For example, investment income that is received in a special tax-free savings account is not taxed at all, while investment income that is received from an ordinary bank account is taxed at a taxpayer's ordinary income tax rate. All right? Thus, two people who have the same amount of investment income but have their savings invested in different types of accounts will pay different amounts in income taxes. As a taxpayer, you want to make sure that you put your investment income, if at all possible, in untaxed accounts. Another example in which horizontal equity fails is if we consider the state income tax. Now, state income taxes differ from state to state. Several have higher income rates than others, and some, like Florida and Washington, have no income tax. So citizens in high income tax states with the same income as those in low tax or no tax states pay different amounts in taxes. In some cases, this horizontal inequity affects where people choose to live. All right, so what I'd like you to do, if you haven't done this already, is go back to the website and locate the Taxes Review and Assessment Worksheet. Complete that worksheet and bring it into class on the due date that is on the calendar. If you have any questions, please feel free to email me. I hope you have a good day. Bye.